Good morning, everyone. I'm Dina Jensen, the Director of the Center for Nonprofit Leadership at California Lutheran University, and I'm delighted to welcome you to today's session on contingency and scenario planning with our friend and colleague, David Greco. I'm really delighted to be co-convening this event with my colleague and friend, Gary Clark from the Santa Barbara Foundation.
Morning, everyone.
And also fostering this space to have a conversation about now what. We've all been, with our eye on survival and even thriving in some cases in this very unusual time. David's going to be taking us through a few cycles of levels of planning, an examination of our financial sustainability and stability during these times. In addition to the Santa Barbara Foundation, a big shout out to the Amgen Foundation for sponsoring this morning's webinar. We're really, really grateful that they continue to invest so deeply in our region, particularly helping nonprofit leaders grapple with their business model and their sustainability plans. So big shout out to Amgen Foundation for their continued support. This morning's session is a meeting, so you'll see that everyone is on camera. If you would like to kill your camera, please remain muted during the presentation. We'll be inviting you to unmute throughout the session to ask questions. You're also very welcome to suggest your questions in the chat box. For those of you who are just getting settled, you're welcome to introduce yourself in the chat box with your name and affiliation. Last night and this morning, you also received the materials for today's session. There's a quick Zoom tutorial that we put together should you run into any difficulties, any technical glitches. But without further ado, I'm going to go ahead and introduce David properly. Many of you have been with us the last couple of years where David has been a big part of our work and has been one of our lead faculty on our Nonprofit Resiliency Institute, helping nonprofit leaders really grok their business model. He's also a practicing executive director in addition to doing this kind of work with capacity builders all over the country. He's a nationally recognized nonprofit leader, speaker, author, does a lot of thought pieces on financial stability and sustainability. And founded social sector partners to help nonprofits and funders better understand what it really costs to do our important work. He created and led the Full Cost Project in California to increase the number of grant makers who are providing full cost funding, and has been very influential with grant making consortiums all over the country. Right now, he's the executive director of All Star Helping Kids, providing early stage investments in emerging nonprofits working to help break the cycle of poverty in the Bay Area, and a very, very trusted ally and friend to all of us here on the Central Coast. So David, welcome home. We're really delighted to have you. You truly model resiliency. This morning, David is in Atlanta and also in a power outage. And so he is embodying the work of resiliency. So he's on a hot spot today. We're gonna lead with understanding and grace. We're really grateful to have you. And we understand that you may have to kill your video at some point in the interest of saving power and bandwidth, but we're delighted to have you, so welcome.
Well, thank you so much. It's such a pleasure to be here. And yeah, I do apologize. I know, so if things start going a little kind of sideways on me, I will make sure to kind of cut off my video. But we had the tropical storm Zeta come through last night and just really take down a bunch of trees, which took down a bunch of power lines. So we are adapting and doing the best we can. But it's such a pleasure to be here with everyone. Again, thanks to the Center for Nonprofit Management, thanks to Dina, thanks to Gary, thanks to the Amgen Foundation for having us back. And thanks everybody for really taking time out of what I know is an incredibly hectic schedule joining with us here today. Dina, did you want to talk about these upcoming programs, or you want to talk about things
Just a quick note that we have a 4-part nonprofit accounting bootcamp that begins next week. They'll be meeting twice a week for 2 weeks with Ann Farmuth, who's a certified public accountant, but also one of a very, very gifted teacher and facilitator in the areas of nonprofit accounting. The class is capped, but we do have a few spaces left. I think about 6 or 7 spaces left. So if anyone is interested and would like more information, you're welcome to reach out to me. And then the next slide is just a quick reminder that the best way to keep up with new programming is to join us on social media. These are our social media channels. You're welcome to join us. I would also encourage you to check out the Santa Barbara Foundation's social media channels as well. And then finally, as is always the case, we welcome you to consider making a gift to the Center for Nonprofit Leadership to keep our workshops, webinars, and programs low and free of cost. If you'd like to consider making a donation of any size, here's the website URL for that. So thanks, David.
All right, thank you. And this is me. So yeah, so definitely follow us. Feel free to take I know sometimes people take screenshots and share them on Twitter or Facebook or LinkedIn or any of those services. For those following on Twitter, my hashtag is right here at David R. Greco. And it's just really great to be here and kind of to talk with everybody today. Obviously, scenario planning, contingency planning, this could easily be a full day workshop. So we're no way going to be able to get into all of the things that we really need to do. So my goal today was to focus on some really top level things, some kind of key things that I found over the years to be really important as groups are kind of struggling through this, whether it was the recession back in 2008, 2009, kind of other disruptions we've had. And of course, obviously with the whole COVID situation, the economic kind of continuing economic disruptions, and there's this national election going on too. So if you haven't voted, I voted, I mailed in my vote. So hopefully everyone's had a chance to get out there and make sure that they're registered, that they're voting. And if you have not already done so. So with that, again, what my goal is today is to kind of start off at the kind of top level, the kind of, start with the basics, kind of go down a little bit deeper, and then kind of take it one level even deeper than that. And again, I'm going to have to stay at, kind of relatively kind of top line on each of those. But I do want to stop at each point and make sure. So if you have questions, again, type them into the chat box, or raise your hand, let Dina know, and she can unmute you if you want to share a question or a comment or a thought. We have about 90 minutes together today, and I really built in some time to make sure that we could have some good conversations on this work. So really, please feel free to kind of type in the chat box in the Q&A box to have any questions if you want to as we go along. The goal of this, and a lot of folks know me that I talk about nonprofit finance, and one of the things I've often said about nonprofit finance is that I think people get finance and accounting confused, right? And that accounting and what we think of as tax, law, compliance, or 990s, getting clean audit and all that stuff, that's part of our kind of fiduciary and compliance work. What I really talk about, though, and why I think finance is really important is that for me, finance is really about decision making. It's about how do we take financial data and be able to really incorporate that into our decision making. And so a lot of my work around kind of understanding nonprofit financials is helping groups, basically be able to pull the financial data they need off of the financial statements. So today is, a little bit different. It's about how do we, look at certain pieces of financial data and then start to think about how can we adapt or adjust to these disruptions and kind of, or opportunities that might come along. So sometimes I know for some groups, what is a disruption for one group can be a real amazing opportunity for others. And I've seen a number of groups actually grow during COVID, during this kind of turn down. where, but we also know that I think the study I saw that at least 2,700 nonprofits had to shut their doors because of COVID alone in the state of California. So, that there are groups out there that, and communities obviously struggling. So how can we really use accurate, transparent, relevant financial data to drive better decision making, which hopefully then can lead to better programmatic outcomes? The other thing I wanted to kind of make a distinction before we kind of get in too far into this is the difference between what I think of as contingency planning and scenario planning. For me, when I think about contingency planning, it is really back of the envelope, down and dirty, kind of, short term, tactical. There's been a sudden kind of drastic disruption. We gotta be able to kind of make some kind of quick decisions. It's still going to involve some key stakeholders, but that's going to differ from a really strategic or scenario planning kind of work, which is a longer term, kind of more strategic, really thinking about what are the kind of gradual changes that are kind of happening over time, and how do we kind of adjust and build our plan to that. That usually develops multiple scenarios with and engaging a much wider range of shareholders. I think for many of us right now, that we just either that we're kind of don't have the luxury to really be engaging in those longer term planning pieces, or even if we do, again, we're looking 3 to 6 months out before we're really going to know the answers, and we still need to do some short term planning. So most of what I'm going to talk about today is really focusing on that tactical, short term, boom, something's happened, how do we make an adjustment? And usually I'm thinking within that 3 to 6 month window, versus we're not doing 3 to 5 year kind of financial planning today. That's not the goal of and most of us are like 3 to 5 years. I can't even think 3 to 5 months. And most of us are focused just between now and, well, either next Tuesday or now and the end of the fiscal end of the year in December. So so I just wanted to kind of lay that out there and have that. The other thing too is obviously these are not one and done, right? These are iterative processes that as new information comes on, as things change, as certain things become clearer, as more information, then you're going to be adapting. This isn't something you're just going to do once and that's going to be it. You may be having to revisit this every couple months, or depending on how radically things changing. But either way, the goal is how do we, for me, about how do we really explicitly and transparently communicate what are some of the potential risks and opportunities in financial terms. One of the challenges is when you're talking just using programmatic terms, I think one of the things that happens is you can get very subjective. Well, I think this, and I think this, and I think we should do that, and I think we should do this. When you kind of take that out and say, okay, what do the numbers tell us? Now, the numbers aren't going to make a decision for us. Right? I mean, as much as I wish I could just plug a bunch of numbers into an Excel spreadsheet and it would tell me what to do, that's not going to happen. But at least we can all agree that this number, this is how much months of cash we have left, right? This is how much this is costing us. This is how much money we're making from this. This is how much money we're losing from that. At least we have that data, and then that's explicit, it's transparent, everybody can understand it. Then we can start making decisions, not off of what we think, but what are the kind of what's the data showing us? So again, for our purposes, again, it's going to be an iterative process, but let's go ahead and dive in and get started. So our first step is really, kind of assessing our situation. Where are we? What's going to happen? Because, what are the tools and information we need to kind of pull together to help do this? And really for me, I think for even before COVID and before all this disruption, I mean, my focus was often on cash and liquidity. Given that before COVID, this is before COVID, 54% of nonprofits in the state of California were operating with 3 months of cash or less. Right? And 22% were operating with 30 days of cash or less. And that number has only gotten worse. So we already had a kind of cash and liquidity challenge for many nonprofits that's really been exacerbated by COVID, not necessarily caused by, but just exacerbated. So what are some of the tools and kits and things that you would need to really kind of help with this scenario planning? So the first one is just, do you have your current budget? Do you have kind of what your year-to-date numbers are against that budget? Now, if you're in a calendar year, right, we're already at the end of October, so you should have numbers at least through September that can really help inform. We are on a kind of October 1 to September year, so we were just 1 month into our new fiscal year. So I don't have a lot of year-to-date data, right? If you're July 1 start, you have July, August, September, you may have about 3 months of data. So depending on where you are in your fiscal year, you may have a lot of actuals and really have a very clear sense of what's happening. Or if you're kind of just starting your fiscal year, you may not have a lot, but at least find out where you are as of today, or at least as of at the end of September. And again, I put up here a very simplistic template. Here's our May. This is actually from All Stars. Again, I'm the executive director of All Stars Helping Kids. Sorry, we're a grant maker in the Bay Area. Really seed funds early stage nonprofits. We do a 3-year accelerator program that provides general operating support, coaching, quarterly capacity building trainings. And so this was my budget back in May for that. And you can see we have for the month, we have our actual, we have our budget, we have our variance, we have our year-to-date numbers, our budget, and our variance, our total budget and the budget to go number. So by looking at this right away, I can have a really good sense of where am I? How's the most recent month been doing, giving us that kind of short-term look. I have the year-to-date numbers, which give me a slightly longer-term perspective. And then I know how much I need to do to close to get to my budget numbers for our organization. So that's one tool. Definitely, if you don't have that, you might want to see if you can work with your finance team, or if you have an outside bookkeeper or accountant, to see if you can pull that together. The next thing that you would need, and this is one that not a lot of groups have, but again, is a current balance sheet. Now, again, your balance sheet is your assets, everything you own, minus your liabilities, everything that you owe. And then, that equals your net worth, what we call our net assets in the nonprofit sector. And so when particularly you're looking at the main asset you're going to really be looking at is your cash, right? Cash and receivables. Cash is the money that you've already gotten in. Receivables are the money that's owed to you, either pledges that people have made but haven't paid on, or government contracts that you've done the work on and you've submitted the invoice and you're just waiting for reimbursements. So part of what you want to do with looking at both your cash and your receivables, again, those are assets on your balance sheet, is understanding, again, what's restricted and what's unrestricted. What's going to be really coming in that you're going to be able to pay your salary and light bills, and what money may come in, but that has restrictions or kind of strings attached to that money. Now, most groups don't do this, and they may do it quarterly, they may do it at the end of the year. But even if you're running QuickBooks for nonprofits or whatever your financial system is, Financial Edge or whatever, you would be able to produce a year-to-date balance sheet that should be able to tell you, where your cash, your receivables, your liabilities, what you owe to other people, and what's your current status of your net worth for that. And also, I think for what we're going to talk about, also, if you have some kind of breakdown of revenue and expenses by program, that would also be really, really helpful. Because one of the third thing we're going to look at is that when we drill down, we start at kind of the organizational level, but we drill down into looking at the programmatic level, because you might be able to say, hey, we have 2 programs that are actually doing okay, but this third one is really taking a hit. Maybe because it was a school-based program or something like that, or it was an in-person program that you haven't been able to move online. And so you may make a different set of decisions about that particular program versus, kind of looking at the whole enterprise overall. So if you have that, again, if you have the most current year-to-date numbers for that program, that would be helpful, or at least some kind of maybe historical data for those programs in terms of both revenue, earned revenue, program fees you may be bringing in, and or support and contributor revenue. So again, I've just provided, you see these simple templates up there. Most of you probably would have some versions of these, just kind of really, most of them are Excel-based tools. I have some resources at the end of this I'll share. One of them, but even now, just look, there's a site called strongnonprofits.org, has a ton of free financial management resources, videos, templates. There's another group called Nonprofit Assistance Fund. No, I'm sorry, they're now called, I think they're now called Propel Nonprofits out of Minneapolis. Kate Barr and her team up in Minneapolis, Propel Nonprofits. You go to their resource section, they have templates, cash flow templates, Excel templates, videos, worksheets. They have reserve policy toolkits, tremendous. So strongnonprofits.org or Propel Nonprofits, I think. The third group you may want to check out is an organization called Fiscal Management Associates. They also provide a lot of training and support around this issue as well. And then a cash flow. I'm going to actually deal with cash flow in just a couple slides, so I'll talk about that more later. But a couple things that just for everybody to remember that. First off, tools are just that. They're tools. They're only as good as the assumptions and the data that you put into it. So crappy data comes in, you're going to get crappy kind of outputs going out. That I think is one thing. Always, again, an Excel template isn't going to solve a problem if you don't have data or you have bad data. The other thing is that tools are not going to make the decisions for you. Even if you have a program that might be losing money, from a mission perspective, you may feel that we have to continue that work, and we're just going to have to find a way to cover the cost and reduce elsewhere to keep that core mission program. Right? If you're domestic violence shelter, that's what you do. You don't, oh, well, that's losing money, let's shut the shelter down. That's your core program. So just because a program might be making or losing money doesn't mean that it automatically gets to stay or go. So there may be a lot of other kind of mission related inputs that really need to be included in this. I'm never one to say, well, the numbers say this, so you have to do that. That's not the way it is. It's about guiding, it's about giving you the information so you have the resources and tools to make the decisions. So David, a couple other things. Sorry, go ahead.
Yeah,
yes.
David, just really quick, we have one question. Can you explain the fundraising allocation in the program slide?
Oh, this here, okay, yes, this fundraising allocation here and this admin allocation here that we do. So one of the things that, and I'm going to talk about this at the very end, but is that when you're thinking about the fully loaded cost of a particular program, right, there's going to be two ways we're going to look at this. One is on a fully allocated basis. That means here's our direct revenue and our direct expenses, plus what is the percentage of the administrative cost, what's the percentage of the fundraising cost that gets allocated to that program. So if we really want to know for program A here, what the fully loaded cost, including its administrative support and its fundraising support, that's what those two allocations do in this model. And there is a tool called the program-based budget model. Program-based budget model. It's available on strongnonprofits.org. It's from Fiscal Management Associates. It's free, and it'll do that type of calculation for your organization. So you can take those indirect costs, those overhead costs, and allocate them to programs so you know the fully loaded cost of all your programmatic work. And that's going to be important to understand this distinction. And again, I'm going to talk about that in a little bit later in the presentation, but that's what that is. All right, Dean, good point. Any other questions on any of the tools I just went through? Again, I think most of them are fairly common.
Not yet.
Okay. All right. I'll jump on. So I'm going to start moving in. There's a couple things that I think that we need to kind of understand in general around our cash, our receivables, our kind of liquidity situation. One is that, as we all know, not all money that comes into a nonprofit is free and clear, right? We can do anything we want with. Unlike when we go to Starbucks, right? When we give money to Starbucks, they do anything they want with their dollar bill. We can't tell them, oh, I only want that money to go to the barista. It doesn't work that way. But in the nonprofit sector, we do have donors who can put restrictions on our funding. And so we may have, in the center here, we have our unrestricted funding, what the accountants call, funding without donor restrictions. We all call that unrestricted funding. But we also get money in that includes either purpose restrictions for specific programs or timing restrictions, usually multi-year. And here's $100,000. You can spend $50,000 in 2020. You have to save the other 50 for 2021. And then, of course, we have our money that's locked up in our endowments, permanently restricted, or what the donors call, what the accountants call, with donor restrictions held in perpetuity. Everybody else calls it permanently restricted. And so they're the accounting terms, which sometimes can be confusing. But again, we have unrestricted, temporary, and permanently restricted funds. But again, depending on how your accountant does it, they may have slightly different names, but those are the three categories. And what's important to know is if you just look at your cash position on your balance sheet and you say, how much total cash do we have? That's including cash that is unrestricted, cash that's what I call in the cookie jar, right? That's cash set aside for next year, that $50,000 we can't touch until 2021. And it includes money over in the safe, which is really our permanently restricted funds. So sometimes when people, particularly board members or donors or somebody who's not familiar with the kind of inner workings of your organizations, will say, hey, you have $300,000 in cash, you should be fine. But if 200,000's in the safe and 100,000's in the cookie jar and nothing's in the middle, you can't pay your salary and light bills, right? Because we can't pay our salary and light bills with money that's in our endowment. We can't pay our salary and light bills with money that's restricted for 2021. Do we? Yes. Should we? No. It's kind of like borrowing from one credit card to pay the other, right? But so understanding how much cash is in each pile is really important. And that can sometimes be difficult during the year. So what we're really focused on is what is the amount of that cash that is really unrestricted and free of liabilities. So some people call that our operating cash reserve. If you've taken many of my finance courses, we have a term called LUNA. That's our liquid, unrestricted net assets, right? What portion of our net worth is free and clear of restrictions, free and clear of any liabilities? And so understanding these distinctions is going to be really cool and critical. And again, when we talk about cash flow in just a couple slides, I'll show you a way to how do we help break those two apart. All right, any questions on any of that? That was kind of just, I wanted to set some context, get some basic tools that I think everybody should be really looking at, and just some things that they should consider. So, but I do want to just stop there. Thoughts, I saw some chats pop up. Any questions or comments? If not, I'll move on. We look good?
Not seeing any yet, David.
Okay, perfect. All right. So again, we're going to start with the basics. Basically, looking at doing some budget reforecast and creating kind of a worst case scenario. Then I want to step it down kind of or up a notch, depending on which way you want to talk about it, to focus on cash flow forecasting and how we could use cash flow forecasting as a kind of contingency planning tool. And then the third one is drilling down into program-based planning, which is a little bit more, a little starting to move into scenario planning work, but it's a little longer term, a little deeper analysis, but something that can still be done relatively quickly. But before we get into those, just some tips. Starting again with your most accurate year-to-date numbers, because getting your baseline right really matters. And when you're starting to kind of make, plans, if your baseline is off, all your projections and forecasts going forward are going to be off as well. So getting that kind of accurate starting point is very important. And then, I always say, and my recommendation is be conservative on revenue. Plan for less revenue than you think. And then aggressive on expenses. Plan for more expenses than you think. And I think that, to me, that's what some people call stress testing. If you ever hear these folks, how do we stress test a budget, right? And that's what we really do, is kind of ramp down the revenue and ramp up the expenses and figure out, can we still, kind of get to a balanced budget? Can we still make it, even if revenue comes down below what we anticipated, or expenses are just significantly higher than we anticipated? But still be realistic, right? Let's not get crazy. I mean, we're professionals. We have experience in this. Some of it is like, we know who our donors are that's going to show up. We know what foundations are going to show up. So, it's not like we're operating in complete utter darkness. It may be, pretty dim, like here I am in my house with no power. But be realistic. Don't get a kind of overly conservative or overly aggressive. And while I say this is kind of a quick and dirty, still talk to your board members. When we did our reforecast, I pulled the executive team together real quick. We have a 30-minute phone call. Hey, this is what I'm seeing. This is what I'm thinking about. Does that make sense? Particularly for an executive director, sometimes you don't have anybody you could talk to. And so pulling an executive committee with just a couple key, really trusted board members. Does this sound right? Am I missing anything here? Have I thought about this? One of the things my team really pushed back on pretty hard was, as I was looking forward, was really on any kind of special event revenue. They're like, no, just take all of that out. I don't think we're going to begin getting back to doing in-person events anytime soon. And I just let's be conservative and just take it all out. I just budgeted a kind of dip in it, and they wanted to do a much more significant reduction of our special event revenue, for example. And maybe if there are some funders or others folks that you particularly if they're significant funders, just, hey, what's happening? What's going on? Are you guys going to be cutting back? What are you doing? Again, just to try and get some more information and data into the process. All right, so I'm going to take you through what happened to me, and I'll share my experience, and hopefully it's fairly relevant. And from people I've talked to, I think they've all gone through similar experiences. This is All Stars Helping Kids. Again, we're about a $1.5 million, $1.6 million organization. And as you can see here, this was our approved budget, which was actually formally approved before I started last year. But as you can see, it called for basically a break-even budget, a small little surplus. But at the end of February, actually about mid-March, of course, the world turned upside down on all of us. So my first question was about mid-March. It was like, okay, given that the state of California just shut down, the Bay Area is shutting down, we're having all of this, we had a bunch of significant events. We had a golf tournament. We do a celebrity golf tournament. We do this other kind of event where we bring all of our grantees together, and we bring in donors, and we have this nice kind of high-end event. We were going to have, there were some donor lunches and other events going on. So, our budget kind of, was potentially could be rocked. So the first thing I did was really just kind of looked at, again, I started with our year-to-date actuals. Where were we through the end of February? And you can see kind of where we were, at that point in the year in terms of our revenue and our expenses, all the way down to kind of say, okay, again, we were kind of breaking even through that point in the year. So we were kind of on track budget-wise. But what really started to change was this projected from March to September. That's really where, I started to cut some things out. As you can see that we had this corporate contribution line, which goes away, which was all the sponsors for some of our events, some of our corporate sponsor money. But we anticipated some people would potentially pony up because of, COVID and our grantees, and they may feel, they may want to make sure helping these groups through. There were some emergency relief funds set up in our area. So the first thing I did was I really kind of looked at and said, again, took out a lot of that special event revenue, took out things that had, any kind of sponsorship for events or anything like that we had, added back in some individual, some foundation money that I thought maybe we could get in relation to COVID. We had some investment income at that point, but basically I zeroed that out because at that point, I had no idea where the stock market was going to go. And my gut is like, I can't count on any kind of investment income. We have a small kind of, board designated reserve and endowment, that we get some money off of, but I was not going to count that. And then on top of that, one of the things that we did was I initially budgeted, we wanted to get out what we created, you'll see in the middle here in red, is something called a rapid response fund. So initially I had budgeted $50,000 to basically just provide some of our grantees with some short-term cash flow needs, helping them keep their lights on and the doors open. Eventually, we actually raised and put out about $170,000 through our rapid response fund, recognizing most of our grantees are all of our grantees are less than $500,000. We fund small emerging organizations. So that $50,000 actually ended up being $170,000. So even in that case, I was kind of below, but we also got more revenue in the door to kind of help balance that out. So this is where I was in March. I kind of cut a bunch of different revenue. I added in a little bit of things I thought we could get. I cut some expenses that I knew would go away because of those events. And because the events go away, some of our kind of special event costs also go away. But I also knew that we had some grant funds that, we have a couple of different grant funding programs. And I introduced this new rapid response fund. So I basically got us to a place where while I cut out about $360,000 in revenue, I was also able to cut out about $360,000 in expenses. So while our overall budget shrunk from a 1.5, 1.6 down to 1.2, I was basically still hitting a break even, a small little surplus for the year. So at this point, we're like, okay, I think if revenue drops by 350 or so, we have a plan that we can actually, get through the year, still distribute some rapid response fund grants, still dispense all of our other funding grant commitments, and basically get to a break even. So the board was like, whew, okay, all right, that's good news. But David, well, okay, that's kind of the best case scenario, right? The best case scenario is that we only lose $360,000. What if it's worse than that? What if it goes, what would your kind of prediction be in terms of that kind of worst case? And so I said, all right, I think that's legitimate. So why don't we take a look at if things really go south for us, where would we potentially end up? Knowing what I already knew, and I knew who certain people were already made commitments and what pledges had been given and where we were in the fiscal year, I put together this kind of worst case scenario where we would not lose $300,000, but if we lost $600,000. Now remember, my original budget was $1.5 million, and I'm just putting a budget down that basically cut $600,000 in revenue out of my budget. That's a pretty drastic reduction. But I said, well, yeah, I think if these certain things happen, if certain funders pull back, if certain donors pull back, instead of losing 350, we could potentially lose up to $600,000 in revenue. As you can see, when I went through the production, whoops, sorry about that. As I went through here, why I was able to, kind of claw back a lot of that, I could probably get to a point where I could reduce $500,000 in expenses. I actually could not cut my way to profitability. I got to a situation where I was like, well, we're going to get close, but I still think, I think we kind of break even, but probably looking at a small-ish deficit. So in the worst case scenario that we looked at, that we really just kind of got our revenue gutted, we were able to get down to a place where I could kind of get most of it back, but not to a place where I was going to cut my way back to profitability. Now, when I looked at that and said 50,000 or so, or, you know, maybe $40,000, $50,000 deficits, again, we have some reserves. So our board felt comfortable moving forward with our kind of plans and our work, because we had given them what I talk about as defining the universe. You know, so our budget was going to end somewhere between, you know, 960,000 on the worst case scenario. You know, kind of the base case would have been 1.2 million. And the best case would be, yeah, we back at our original budget at 1.5, which we already had. That's our original budget. But the baseline really for us was really this new baseline of 1.2, the reforecast is what we call it. So we had this $1.2 million budget, but I also went down as low as a 960,000 budget as a kind of worst case for us. So now my board felt really comfortable that they understood the universe, the possibilities that would happen, and that we were going to end up somewhere in between there. And that just gave, I think, my executive team in particular, but my full board overall, a lot more comfort about moving forward and not having to, you know, lay off staff or make any kind of drastic programmatic reductions or cut our grant budgets or do any of that. You know, because if we go even further down, that's what we're going to have to do. This budget allowed me to keep my staff. There's only 3 of us anyway, but we have 3 staff members. Allowed us to keep them on full time and meet all of our grant commitments, which was my primary goal for this planning exercise.
David, I have a couple questions.
I was just going to stop and answer.
Okay. So the first question, I think you just answered it. So there wasn't a reduction in force. You didn't have to decrease any of your staff levels.
No, we did not. But we had some plans to bring on some additional support, and that got cut out. Like some temporary, some contractors, some consultants. We did cut those out of the budget.
And then the other question is, can you speak to how in-kind contributions are calculated and how they show up in your forecast?
So for us, our in-kind is primarily really two sets of work. One is we have a law firm that provides pro bono legal services. And so what happens is at the end of every year, they actually send us an invoice that tracks all of the hours the firm gave to supporting All-Stars. And then they kind of write that off, or they say this is our pro bono. So they base that off of their actual hours as a law firm. And so whatever hourly rate they charge, this is how many hours we gave to All-Stars, and they make that calculation and say, this is the value of your in-kind support. So that part is very easy. So if you typically have accountants, legal, kind of legal in-kind support, accounting work, anything where there's usually a fairly generally accepted standard rate. Therapist is another big one. Counselors and therapists, usually all of them charge standard rate hours. And simply you say, how many hours did they give us? What would have been their normal rate that they would have charged? And that's it. The other work what we do is we have what we call our advisors network. These are business professionals in a whole variety of different fields that provide kind of free coaching and technical assistance to our grantees. I'll give you a great example. So when our grantees were trying to apply for the PPP loan, again, these are a bunch of small nonprofits. Right? They've never applied for Small Business Administration loans. They're not even familiar with the terms that were on the application form. They're like, who's an owner, right? And so we had a group of volunteers from Deloitte, Point Sloat Capital, and Next Play Capital that worked with our grantees to actually help them to fill out the PPP application. And 13 out of 16 of our groups got those PPP loans. And again, so what we had to do was, well, how many hours did the team at Deloitte give? How many hours did Point Sloat Capital give? And again, we had to equate a kind of hourly value to that and multiply that across. So just to remember that for audits and internal tracking, you can track both in-kind services, legal services, marketing, management, therapy, as well as in-kind property and gifts. But for the 990, it only counts in-kind property. Only if somebody actually physically gives you a tangible asset like that, then that counts as in-kind on the 990. But for your audits and internals, you can also include in-kind services. But they have to be considered professional services. Again, marketing, legal, HR, accounting services like that, not traditional volunteer services like helping give out water at the 10K or stuffing envelopes. Dina, were there other questions?
Nope, I think those were the two so far. Oh, there is actually how much cost for and how often should we have audits?
So typically in the state of California, you're not legally required to have an audit till you hit $2 million in revenue. But many funders and grant makers and even government agencies will require audits at lower levels, most often around $1 million. I've seen it go as low as $500,000, but $500,000, typically. But now it's depending on the size. It's really depending on the complexity of your organization, how expensive the audits are. I think our audit cost around $26,000 that we spent for. Again, we're about 1.6 million. So that's roughly the cost there. I know for some smaller groups, again, I've seen it. You can do it maybe closer to 8,000 to 10,000, something like that. Typically, though, for me, we do it every year, and we're at a size where I think that makes sense. I really feel if you're over $1 million, you should really be doing an audit. Although again, it's not legally required. If you're under $1 million, again, that's something that's an internal decision for you all. But once you do it, I find that I typically would want to do it every year. And that comes back from when I very, very first started in nonprofit. I had an amazing executive director at the Horatio Alger Association, and he said, "We always want to be beyond question on our financials," because he never wanted to any board member or donor or anybody to ever be able to question our financials. And so, even though we were a very small organization, he had KPMG, and they had like a outside really accounting firm preparing our numbers and our audits every single year, just because he never wanted people to kind of in any way question our numbers. So that's I very much agree with that philosophy. But again, depending on the size and complexity in your donor relationships, it may or may not make sense if you're under $1 million. Just to stay with some internal or kind of other internally prepared financial statements. Great questions. All right, let's keep going because I want to honor everyone's time and make sure we get through everything. So next, so that's kind of the top level, right? That's kind of a high level organizational kind of budget reassessment. That doesn't necessarily break things down by a calendar year, or doesn't really get down into the big question everybody has is, am I going to make payroll, right? So I want to talk a little bit about cash flow, using cash flow projections as a kind of scenario or contingency planning tool. Because I think I think the, recessions and kind of events like COVID put a lot of constraints on cash. And the more visibility you have into your cash position, the better that you're going to have. The main thing that I want to do, is help folks understand this distinction between a cash flow problem. Now, a cash flow problem is usually what people call a timing issue, right? We've submitted an invoice. We know the county of Ventura or the county of Santa Barbara is going to pay us within the next 2 to 3 months. But right now, all I have is an IOU, and I can't pay my salary and light bills with that. But if I know the money is coming in, that's a cash flow or a timing issue of when that money comes in and when my expense hits. The other one is a cash issue, which means a shortage of overall cash, which means we just don't have the money, and it's not about a timing issue because it's just not coming in. And that's important. Is this is simply a timing issue that if we can delay a payment a month, that money is going to come in? Or is this a cash issue where it doesn't matter how much we delay our payments, the money's not coming in? So I think that's really the kind of key piece here. I've talked a lot about these things. The one thing I think is the third bullet point here is that focus on when do you actually really expect that money to come in. Don't just sit there and say, oh, we're anticipating $100,000 in individual contributions. We'll divide that by how many months, and that'll give us what we're coming in every. Now, when is that money really coming in? And try and get as accurate as possible on that. Also, I think it's key thinking about payroll schedules. Usually there's usually 2 months in every year where we have 3 payroll schedules. If you do bi-weekly every 2 weeks, right? So it's because if there's 26 usually payroll periods in a month, in a year, and there's 12 months, and so when you divide that, it doesn't come out to two per month every month. So there's always 2 months where you're going to have 3 payroll periods. And so when you're planning for cash flow, just remember that cash flow isn't always, for salaries and payroll, isn't always the same month to month. And some months you may have higher than others. Also, there's sometimes payments like insurance or rent or other costs that you pay quarterly or even annually, and these lump sum payments. And again, in our budget, we sometimes spread those across, but in terms of cash, they go out in a particular month. All right. This is a simple cash flow template. You can find this easily online. Any of the websites I directed you to, you could go there and find this out. This is not All Stars. It's just a template that I wanted to use that I kind of showed, that shows a couple key things that I'd like to focus on. The biggest thing for us here is, let me do this, is that you see this total cash line, and then you'll see underneath of that, you'll see this term called unrestricted operating cash. And then down further, you see non-operating or restricted cash. So what I like about this template, and I think this might be from Propel Nonprofits, this particular template. If not, I know there's some templates out there that I think Nonprofit Finance Fund may have made that as well. But this segregation of unrestricted cash at the top and restricted or kind of non-operating cash at the bottom, and to make sure we're understanding these distinctions. Because one of the interesting things here, and again, this is our kind of baseline budget already, but you see that if we just looked at this yellow line across the top, at no point during the year do we run out of total cash. However, if you look at the green line, you see that in May and June, we actually run out of unrestricted cash, which means that we would either be using restricted cash to kind of get through those periods, or we may have to kind of delay some expenses, paying some invoices until cash comes in. Mainly that's because if you look here at this special event line, you see that there's a big special event in June. And so there's a lot of expenses associated with putting that on. And then the money usually comes in usually at that event or below that, right? So you see that we have, in this case, some big money coming in from a special event, as well as some school-based, there's a program this organization runs as an after-school program where they're getting some program or earned revenue from that. So this is, again, similar time frame. They've had this was April. So they have January, February, and March. They have their actuals. So they know where each month, how much cash, where they started, how much cash came in, how much cash went out, and their net operating cash. So in January, they started with 71,000. They had 56,000 come in, but 65,000 go out. So they actually, their cash amount dropped by 9,000. Their unrestricted cash, this green line. But they also got a restricted grant, a grant that came in that, as you can see, was supposed to be released in June, September, and December. And so that money came in January, but it was restricted. It's in the cookie jar until later in the year, so we didn't have it. So while our total cash went up, very significantly because of that grant, our unrestricted cash actually went down. So that is why we want to pay attention to the difference between total cash and that unrestricted cash in our numbers. So this organization had $220,000 from June special event and another $70,000, so almost $300,000 in revenue just in these two line items in this kind of April through July timeframe. But of course, as we know, mid-March hit, right? COVID hit, everything shutting down. We know those things are probably not going to happen. So what did this organization do? What did it kind of look at? So the first thing that they did is said, okay, just like we did for the budget reforecast, is we looked at the revenue and started to make some adjustments there. We figured there might be some of our donors who would still either still give some funding for the organization. They say, listen, we've had to cancel our gala, but we still need to operate our programs. Would you be willing to take your sponsorship for the gala and convert that to a grant for the organization? So we knew we wouldn't lose all of that money, or this group knew they wouldn't lose all of that money, but they were going to lose some of it. So they went from 220,000 to about 100,000 for that. But the program fees from that after school program, they're gone. The program, school shut down. There was no after school programming. None of that was going on. So we're not seeing the kids. We're not charging. We're not submitting invoices. So we lost, about 170 something, $75,000 in revenue. What that did was that we ran out of unrestricted cash by May. So this was in April. This group was in early April. They were doing this reforecast. And they were saying, man, our unrestricted funding is going to run out by May, and all cash in the organization will run out by September. All right, so now I have some data points that I'm going to have to figure out how to deal with that. So that's really telling me where are my drop dead dates. So some of it is I need to figure out a way just to get through May and June. Then I can start thinking about, can I get us to the fall? So this organization, a couple of things that they did. One was reduce some programmatic expenses, of course, right? That's and all the programmatic expenses that was associated with that after school program. So the teachers that were in that program, or the teacher aides, or whatever we had, those folks were all kind of let go, or not, kind of their work was not renewed. So that was able to save some more organization money there. The second thing they did is they went back to the funder and said, listen, I know this money was supposed to be released over the course of the next 9 months. Would you be willing to kind of allow us to release that now and make that general operating support to us? And I think when COVID first hit, the number one recommendation that everybody made to nonprofit organizations was talk to your funders and see if they would release their unrestricted funding and kind of convert that to general operating funds. And a number of foundations, I know, at least in the Bay Area in California, immediately made announcements that they were going to be much more flexible about their grant making. But not everybody did. Not all funders did that. Some groups said, nope, this is what we're funding. That's what we're committed to doing. So when we did just those two things, having that funder release those funds early, making some programmatic reductions, one of the things that we did is that kind of helped us at least get through that kind of May to July, August timeframe. And now I'm not going to really have to run out of money until October. So at least what this gave me by being able to kind of do this work, it gave the organization a sense of, okay, whew, I think if we can just do those two things, that's going to get us through to October. And that gives me 4 or 5 months to really start doing some planning, figure out what's going on, doing that longer term kind of scenario planning work and longer term contingency work. It gives me a chance to meet with my board members, my donors, my funders. So this is, again, a fairly simple kind of routine. Now, if we were still having cash flow problems, you know, the next step would be go into all the other kind of expense line items and start making reductions. For the purpose of this, you know, it wasn't necessary because we got that grant pulled forward, and we got that released to general operating support. And 2, we did cut some programmatic expenses. Now, there might be other things. Again, if we want to start kind of fine tuning this and honing this, we may be able to find more money that we can cut over the next few months. And we may be able to, because actually, if you look at those amounts, 17, 16, so if I could find another $20,000 maybe, or $30,000 of expense reductions, I might be able to get us through to the end of the fiscal year with the current cash on hand. So now, immediately you see the executive director kind of like, whew, okay, I can breathe now. I have a little bit of sense of some things. And I think if we're smart on the expenses and cut some and reduce some further expenses, I think we're going to be able to make it through to the end of the year. And at least, again, you can start to see the levers, right? You can start to see where we can reduce some expenses, where might be things we could potentially get some additional revenue in, and how that's going to help us get through this next short-term period of time. Now, again, this is a fairly simplistic, I think, template and kind of exercise we're going through. Of course, for your organization, you know, it may be much more complicated and difficult than this, but I think conceptually, the idea by the good points, the difference between what we just went through, which was the budget reforecast, really just is kind of tells me, you know, here I am now, and this is where I think I might end up. It doesn't tell me what happens in between. The cash flow forecast allows me to figure out what's going to happen in between. In particular, when am I going to run out of cash? When are we going to have to ask senior staff to hold their paychecks? Right? When are we going to maybe start delaying some payment to vendors? When are we going to have to maybe look at, you know, renegotiating our lease? You know, laying off, maybe when are we going to have to start thinking about furloughing other staff? It gives me a sense of when things are going to happen within that time frame. And if I can make some adjustments, how much further can I push those decisions down through the fiscal year? And hopefully in this particular case, this organization was actually, at least again, from a cash flow perspective, able to put the plan together that eventually got them through the end of the fiscal year. The good news is the revenue came in a little higher than they had projected. And they ended the year in the black. So they're looking to end the year in the black. We're only at the end of October, but they did not run out of money in October. So I think, you know, but looking back in March, and nobody had any idea what the heck was going to happen. You know, we were operating in just, you know, unprecedented times. But going through this exercise really helped both the executive leadership, the board leadership, just have a little bit of sense of, okay, we have a little space, we have a little time, no need to panic, right? We can manage through this. Now for you, you may go through this, and when you start cutting and adjusting, you may say, like this group was back here, which is, oh my God, we're gonna run out of money in May, right? And we're gonna be totally kind of, you know, everything's gonna grind to a halt in October. You know, and again, I mean, that may not be, you know, it's definitely not good, but at least you know what the situation is. Then you can start making some adjustments. If you don't have this kind of a cash flow forecast or template or anything like that, and you're just looking at what's in your bank account and you don't even know what money in there is restricted, what's unrestricted, and you just start burning through that cash, it's really easy to get into a place where you've already not only eaten up your unrestricted cash, you've already spent money that's been restricted, and it's kind of in that cookie jar as well. And some people have even dipped into their endowments. Again, sometimes it's with, they've gone back to the donors, and some of the donors has kind of allowed them to use some of those funds. Other times they've done it unintentionally. But this is a tool that can really help you kind of manage through that. All right. I wanted to stop there and see if there's any questions on the kind of cash flow forecast. Again, this is not All Stars. This is not our organization. This is an organization I had worked with to help them kind of think through this. But if there are any questions, I can answer any general ones.
So David, I don't have any in the chat box, but I would welcome anyone to raise their hand or unmute themselves if they have a comment or a question for David at this point.
And again, I also do want to offer that, my contact information, I'll share that. You have Dina's information, Gary's information. If there are questions or things that come up later, I know what sometimes happens is people take the slides and they take it and say, oh, what about this? What about this? Shoot me an email, afterwards. And if there's a really specific question to your organization, I'm more than willing to kind of take the time to get back to you. But given that we have about 20 minutes left, I have one other thing I want to hit. And then again, if there's any kind of final discussions. The last one I want to talk about is, okay, we have the top line kind of, budget reforecast. I did this kind of cash flow, looking at when money, how long we can keep money in the organization before we're going to run out of cash and not make payroll. The next level down, the kind of level of intensity, is starting to look at the programmatic budgets and start to say, okay, not only just where is cash going out, but which program is eating up that cash, or which kind of division or section of the organization, where are we bleeding the money, and how can we help to stem that, and potentially how can we make some adjustments. Now, in order to get to this, and this goes back to that question somebody asked earlier about those allocated expenses, that when we oftentimes when they're in kind of accounting or in budgeting, there's 2 or 3 different kind of cost categories or expense categories. One is the direct. These are specific expenses. Now, when I say direct expense, what I mean is if that program goes away, that expense goes away with it. Just like that after school program went away, and the teachers and teacher aides that were doing that, their expenses went away as well. That's a direct expense. What a lot of us do are these allocated expenses. These are sometimes shared expenses. They could be things like rent or utilities, office supplies, depreciations, things that we basically just kind of allocate to programs and different departments based on, if one organization is 60% of our staff cost and salaries, they get 60% of the rent, or they get 60% of office supplies, whatever that happens to be. So these tends to be kind of, allocated expenses that we kind of, or most often what people call shared expenses. But they are a form of kind of, sometimes some people consider them direct, like rent. Sometimes people consider them indirect. But technically, I think the best way to think about these are that are shared across the organization. But the thing to remember is that, yes, why we may have put a portion of our rent towards program A. If program A goes away, we still got to pay our rent, right? We still have to pay our mortgage. We still have to pay the light bill and the utility bill. None of that goes away when program A goes away. Right? Now, if we get rid of the building, or if we're renting a space where we're housing that and that goes away, then that's really a direct program, not a shared expense. So we have specific direct expenses. We have these shared kind of overhead expenses. And then we have our, IT or HR, our kind of legal, our fundraising. These are our true kind of indirect overhead expenses that many people allocate as much as possible to programs. But again, when that after school program went away, why I did reduce my they reduced their teachers and teacher aides. They didn't let their fundraiser go. They didn't let their director of development go. They're still paying that person a full staff. So even though they allocated a portion of their budget, portion of their fundraising costs to that program, those expenses do not go away. So the question you always need to look at and think about when you're doing programmatic based work is what expenses go away, what expenses stay. And the same on the revenue. If we were to close down a program, what revenue really goes away and what potential revenue may stay, right, or go. Sometimes somebody may be giving you a general operating support grant, but they're doing it because their kid is in your program. And even though you closed down that program and their grant wasn't tied to it, you may lose that money anyway. And so thinking through what really money is we're going to lose and what expenses are we going to lose, and not just looking at what all of the allocated expenses are. This is what I just talked about. Typically, what I'm about to show you is much more of an internal kind of ED, kind of internal planning document. It's not necessarily something that you would traditionally share with funders or donors. So this is one point. I'm all about transparency. I'm all about, kind of being open. But at the same time, the executive leadership needs to be able to kind of work through numbers in a way that helps them with management decisions, but that aren't really appropriate for external audiences. And so I think this is definitely one of them in that sense. So again, if a program goes away, understanding what really goes away and what stays. So let's use an example. This is a template that's provided by Fiscal Management Associates. It's part of their program-based budget model. Again, program-based budget model available on strongnonprofits.org for free. So I basically took that and kind of populated that with an organization that I knew to kind of create this. And again, you see programs A, B, and C. You see their management in general, and you see their fundraising. You see their total revenue. Again, a small organization, which is what we work with, $450,000. And then here's their revenue. And so this group is already kind of looking at a small deficit even before COVID, but basically break even, but a small deficit. But one of the things that when we break out our things this way, right, when we actually really start to look at what's the revenue and expenses. So you'll see here a couple of things. See here where we have an executive director and our program director, right? When we think about these expenses, right, these are allocated costs, right? Because if program A goes away, are we going to cut the executive director salary by $25,000? Are we going to cut the program director? If yes, then that's great. They're true direct cost. But in most cases, no, we're not going to fire our executive director just because program A went away, right? So these costs here under executive director and program director actually are not true, direct costs. So if program A or B goes away, those costs probably are not going to go away with it. Likewise, with things like rent and utilities and things like that, those costs tend to not go away when program A goes away. Again, if we are renting a space where we're housing program A, say we do a summer program and we rent a camp where we host our summer program. Well, we're going to cancel our summer program. We're going to cancel our, we're not going to rent the space. Yeah, in that case, I'm actually saving that money. But if you have a big building and a program's just using one room in that program, if it goes away, you're still paying the full mortgage or rent for that building. So understanding that these costs here are not direct program expenses. They don't go away when we close down program A. That's my little rhyme for the day. Oh, there it is again. But you look here, you see teacher A and teacher B, you see classroom supplies, snacks, and a bus rental. Well, these are direct costs. So if program A goes away, teacher A goes away with it, just like we saw in the after school program. Also means if we're not hosting that program, we're not buying the food and supplies for the kids. We're not doing the bus rental because we're not bringing them to the program, right? So these are actual direct costs that do in fact go away when that program goes away, or they get reduced if we reduce that program, right? So if we serve fewer kids, we're gonna have fewer snacks, we'll have fewer classroom supplies, right? So those are things to understand, this difference between what really stays and what really goes. And you should also be thinking about that in terms of revenue. Because again, some of this revenue, obviously anything that's you see client fees, and we have these kids that are in this program. Oh, power just came back on. Yay! You see these client fees. So if we close down our after school program or preschool or early childhood education program, those fees go away with it. So we lose this revenue. And same thing with program B here, you see they have a government contract. Now, one of the things that actually happened during COVID is a number of county and government agencies and schools even said, well, even though we're not having the after school program, we'll continue to pay on the contracts because we know if we stop, a bunch of nonprofits are going to go under. So, you know, this may be direct, it might be indirect, you know, it depends. So this is truly going to go away if the program goes away. This may or may not go away depending on, you know, the individual kind of government agency that is housing that. And likewise, for the contributor revenue, your foundation money or your individuals, I might be able to go back to this foundation here that's funding program A and say, hey, listen, we're going to have to cut that after school or early childhood education program, but would you be willing to convert that into a general operating support grant because, you know, we still need the funding? And so you're going to have to go through and figure out which one of these may go away, which one of these you think you can stay and keep that. What this ultimately will look like is we kind of take that initial budget reforecast I did, and then this, and you're going to create something like this. Now, I can send you the template. Again, this is something Fiscal Management Associates does, and so you can do it as well, but I can send you this actual template here. So here was their original budget, which they defined as their, okay, Alexis is talking to me. This is their best case. But what they did is they kind of went through this and started to create what they call a moderate case and a worst case scenario about if we were going to have. Now, you could do this. The tool actually allows you to do this per program. And what you see here, they use kind of percentage drops, or alternatively, the model allows you to use actual numbers in here. But that's not as important as, you know, how you kind of do it is as a sense of understanding, okay, yeah, we're going to lose that. We're going to lose that grant. We're going to lose that contract. All right, that's going to put us over here in this kind of worst case scenario. And then what that did is it created for them 3 different levels of scenario: 450,000, 400, 350. And then what their deficit would look like under each of those different scenarios by how much they really needed to cut. And again, you can see that when they were getting to this worst case scenario, they were starting to kind of eliminate a lot of different programmatic expenses. So this is a pretty kind of rough situation. But they were doing that based off understanding kind of within these programs, what's really kind of staying, what's going, and having this sense of, okay, I think that money we can keep, those expenses, they're going to have to go away. And it gave them a bunch of different levers. So for each program, we have these different revenue and expense levers we can start to move. So obviously you see why this starts to get much more complicated, particularly if your program, if you have like 27 different after school programs with, 25 different school districts or something like that. This could become a very complex model very, very quickly. And again, this is kind of what I think of as kind of next level. But it takes that initial reforecast that we did and drills down into the programmatic level a lot deeper. I'll have some closing thoughts and then I'll see if there's any kind of final questions. I know we only have about 7 minutes or so left on today's show. So I've talked a lot about access, about liquidity, cash, because really, if the organization doesn't have the cash, you're not able to access a line of credit, you don't have reserves, right? The one formula that this was from my nonprofit finance fund days, which is, risk minus cash equals crisis. And so when people are in the middle of COVID, that's a big risk situation, and you don't have access to cash, that's going to put you in a crisis situation. If you have access to cash and you have the ability to kind of manage your cash, it's going to put you in a much kind of, more a situation where you can be much more planful and thoughtful about your work. Communication, both internally with your staff, with your board, with your donors. Don't try and do this work in a vacuum, just sitting by an executive director sitting in a room by themselves doing this. It's not going to produce good data. Really talk to different people, get as much accurate information as you can about where people really are. This is not the time to pull back. This is really a time to, in some ways, I started doing weekly board updates because I was just really concerned that I needed to over communicate. And so for about maybe about 8 weeks, when the crisis first hit, I was doing weekly board updates. Every Friday I'd do an update. This is where we are. This is what's happening. This is what's, kind of come in. This is where we are. And then as things started to ease up a bit, we started to kind of, go back to a more kind of monthly updates. But there was still a lot of communication, particularly between my board chair, my executive committee, as we're looking at. And we also my development director literally picked up the phone and called every single one of our donors over what we consider a major donor, so over a certain dollar amount, and called. It was like 170 people. So we are actually physically on the phone, calling our donors, checking in, saying thank you, seeing how they're doing. Not asking for money, just kind of telling them, hey, we're still doing this work. We're doing this. This is where we are. This is what's happening, and that really helped keep them with us. And allowed us to really navigate through this and end the year in a financially healthy position. This is from Propel Nonprofits. Again, part of what I think we need to do as we think about this work is this old view of kind of having program, admin, and fundraising as these kind of 3 separate, distinct operations isn't really how we operate. And so part of what I think that program-based model and that other kind of year-to-date budget number I showed you, what they're trying to get to is much more of this, that we need to recognize that every single program has direct expenses, has shared expenses, has like HR, finance, IT expenses, as well as fundraising expenses that are associated with it. And so all of our programs have all of these expenses doing it. So it's not like we can cut just one piece and it doesn't impact what's going on and elsewhere. And so when we're thinking about this, we really need to understand kind of the interrelationship of all of that. And at the end of the day, 100% of every dollar that ever comes into your organization goes to impact. If that's not true, then I don't know why you're doing this work. But every single cent that comes into every single nonprofit goes to impact, whether it's spent on fundraising, whether it's spent on IT, HR, or program. They are all necessary to drive outcomes in this space. So that's our show for today. We have just a couple minutes. I think we have 3 or 4 minutes. If folks have questions with Dina, if there's anything that you want to kind of share before we wrap up,
Well, so now that the electricity is back on and your crystal ball is working, um, any insights on how to predict or forecast the COVID impact for the next fiscal year for 2021 and beyond?
You know, I do think there's a couple things I think folks are going to have to deal with. One, in particular, I just don't see kind of if you're any kind of event-driven organization, getting back to any kind of in-person events really between now and next June is probably extremely unlikely. I know particularly in the Bay Area, it's not going to happen. You might be able to start doing some small, kind of really kind of donor events or even outdoor events. I've seen some groups trying to do and some drive-throughs and things. So I definitely wouldn't anticipate getting back to really doing a lot of in-person things anytime soon. The other thing is that while I think there was a lot of groups that when we first happened, we did online galas and we're doing these online fundraising and online lunch and learns, and everyone was like, oh, this is really working. Yeah, that worked for about 6 weeks. And then everyone had Zoom fatigue. And then those things started to kind of tail back off. I think for us, I think that the ability to kind of continue to kind of get attention in a virtual world is actually is going to be really, really hard. I think it's going to be brutal over the next 6 weeks because we're not going to hear anything about anything going on in the world except the election recount numbers for the next 4 weeks. So I think that I think that the challenge of how do we think about engaging our donors and our funders and our partners in a world where there's so much noise and so much going on, that now we're really having to be thoughtful around how we create really unique events, and something that really, to me, it comes down to this core question of understanding who is your core customer and your core donor and what do they value, and how can we create events that really bring value to what they're doing. Just moving our fundraising online, just moving our gala online, I think that will work. It worked initially, but I'm starting to see a kind of a diminishing return on those events. And I think there is some donor fatigue just with COVID and the election. There is definitely some fatigue out there in the fundraising space. So I think this final point that I have on this slide here is it's all about impact. We pushed out an impact report. Every email that goes out talks about the impact of our work. It has numbers. It shows the people. It shows the need that we're trying to do. It shows how we're responding. It's all focused on that impact and communicating that story, and just really kind of hitting that hard, because I think for us, it really is demonstrating, that this approach works, and we really need it to continue. But I actually think it's going to be a rough couple months. And so we've kind of, like for us, even now, even in our new budget, I have some hot positions. I push them out to the spring to bring that on. We're fortunate to have a donor step up and agree to fund one of our positions for the next 3 years, one of our program positions, which was fantastic. But I had initially had plans to bring on some additional staff, and I kind of delayed them and delayed some other investments as well, just because I'm a little pessimistic over the next few months. But I think it will. I think if we keep at it, it will turn around.
So David, we have a pretty meaty question here. I'm going to really quickly just invite our colleagues to join me in a virtual round of applause and deep sense of gratitude for your time today, and for soldiering through to be with us today. The question, and so I'll just say that I know that folks are scheduled really, really tightly, and a few folks have already said they had to jump off for their next meeting. We're going to be sending the rest of the slide decks, which is chock with additional resources. I'll be sending these slides, the recording for today's webinar, and a couple of other links. Our colleague Lori actually had a question that was, how do you calculate the spread of admin and fundraising expenses? Is it simply a spread based on percentage of total budget for each program? I'm struck by the challenge of balancing the budget for the sake of planning and balancing the budget for the sake of fundraising and grant writing. So I know we're going to unpack, and it's a whole nother webinar, but
there's two main ways I've seen. I mean, there's many ways. There's two in particular that I've seen that have been most common. One is that first what you do is you look at what is the percentage of your total salary base that a particular program represents. So you take all the staff that are directly assigned to that program and their staff, their salaries and their benefits. And then you take that total number and you divide by the organization's total kind of payroll line. And that'll tell me that program A represents 42% of our payroll, in which case they then should get 42% of the allocation of all of the indirect expenses. And then if program B accounts for 26% of our kind of payroll baseline, then they get 26% of the allocation of expenses. I'd say that's the most common way, and the way that the FMA tool does it, the program-based budget model. The second way that I've seen it allocated is by number of people served, particularly if you're, sometimes school-based programs or others, where if you have program A and they have, 70% of the people in the program going through that program, and that means they need 70% of the supplies, they get 70% of the allocations, even though they may only have 1 or 2 staff people, right? Because there's certain programs where you can have very small staff, but have to serve a really, really large number of people. And then that for things like, meals and supplies and transportation really becomes kind of disproportionately weighed towards one program because of the kind of people participating in that program, given the nature of it. The most common is basically you use your employees, full FTE, full-time equivalent or full-time employee, what percentage of those represent of your total budget and allocate accordingly. Or again, you could use the number of people being served. There are other methods. I'd say those are the most two common.
Fantastic. David, thank you so much. And
Thank
it's great to see you. You take good care. Go flip on all the lights in the whole entire house. Thank you again for everyone and your time and your expertise and your leadership during this unprecedented time. If I had a nickel for every time we've said unprecedented time, yes, we would all be rolling in the dough. We'll see you.
We'd have so much cash.
Indeed. We'll look forward to seeing everyone once again. My colleague Jenny Lynn Tumalata has been working diligently on our first quarter workshops. If you have any suggestions or requests, I would welcome you to send them to us via email, and we'll be sending the post-event materials out either later on this afternoon or first thing tomorrow. Again, a deep sense of gratitude. Thank you so much, David.
Thank you all so much. Thank you, everybody, for joining.
Take good care.
Take care.